Welcome to The Explainer. Today we're going to tackle a huge question in economics by digging into John B. Taylor's landmark paper, Discretion versus Policy Rules in Practice.
Have you ever wondered how the people running the economy, at places like the Federal Reserve, make those huge decisions? The ones that affect everything from your mortgage to the price of gas? Is there some secret formula they follow to the letter? Or are they just kind of winging it, reacting to whatever's in the news that day? This isn't just some dusty academic question. It's one of the biggest debates in all of economics. And that question? It drops us right into the middle of a fundamental, high-stakes debate at the very heart of how you manage an economy. We're talking about a clash between two totally different philosophies, and the choice between them has massive consequences for all of us.
Okay, so the main tool we're talking about here is something called monetary policy. And in simple terms, that's just the central bank's gas and brake pedals for the economy. They can hit the gas to speed things up or pump the brakes to cool things down, usually by tweaking interest rates. A really great way to picture this is to imagine the whole economy as a massive ship. And the central bank, well, they're the captain on the bridge. The big question is, how should that captain navigate? Especially when you have calm seas one minute and a sudden violent storm the next. Should they just lock in a course and never ever change it? Or should they just steer based on whatever they see in front of them?
And that brings us to these two warring philosophies. On one side, you have the people who argue for strict, preset rules. And on the other side, you have those who believe in pure discretion, just relying on the captain's judgment and instinct in the moment.
And listen, the trade-offs here are pretty dramatic. A strict rule is great because it's predictable. Everybody knows what's coming, which creates stability. But, and this is a huge but, it's super rigid. What happens when your ship is locked on course and bam, an iceberg you never saw coming appears right in front of you? Pure discretion is the exact opposite. It's totally flexible, ready for anything, but it's also unpredictable and can get pushed around by politics or panic, leading to some really short-sighted decisions.
So you can see the problem, right? For a long time, it seemed like you had to pick your poison. A robot captain who's steady but can't think for itself, or a human captain who's a genius one minute and maybe a little erratic the next. This whole dilemma leads to the million-dollar question, is there a middle way?
And this is where Taylor's work was a total breakthrough. He came along and introduced a whole new way of thinking about what a policy rule even is. He said the goal isn't to be mechanical, like a robot. The goal is to be systematic.
I mean, Taylor himself said it perfectly. A rule doesn't have to be some rigid formula that you just plug into a computer. No, he argued it can be a framework that actually requires human judgment to work right.
And this gives us this new concept, a systematic policy. It means you're methodical. You have a plan. You're not just making it up as you go. Think about our ship captain again. This is the skilled captain who has the best navigational charts and instruments. They have a clear destination, a plan, but they use their experience and judgment to actually read the waves and steer the ship.
Okay, so that all sounds pretty good in theory, right? But what does it actually look like in the real world when things get messy? Well, Taylor didn't just come up with an idea. He created a practical tool to show exactly how this could work.
And that's the famous Taylor rule. And honestly, it's basically a simple recipe. It tells the central bank to keep its eye on two main things. First, inflation. How fast are prices going up? And second, the output gap, which is just a fancy way of asking, how is the economy doing compared to its full potential? The rule then gives them a guideline, a starting point, for where to set interest rates to keep both of those things in balance.
But again, that's the theory. Does this systematic approach actually hold up when the real world throws a massive curveball? Let's put it to the test with a classic crisis, the oil price shock of 1990. So in August 1990, Iraq's invasion of Kuwait causes oil prices to go through the roof. We're talking more than doubling in just a few months. And that, of course, sent a massive shockwave of inflation across the entire global economy.
Now, if you were just a machine following the recipe, the answer seems obvious. Inflation is spiking, so you got to slam on the brakes and raise interest rates to cool things down. Simple. But was that actually the right move?
And this is a perfect example of the systematic approach in action. The people in charge didn't just blindly follow the formula. They used their judgment. They looked at all the data and figured out that, you know what, this price spike is probably temporary. So they made the call not to raise interest rates, which would have needlessly hurt an already shaky economy. That's judgment within a framework.
All right, here's another real-world test that happened around the same time, the huge event of German unification. Now, this one wasn't really a crisis, it was more of a mystery. So in early 1990, policymakers all over the world are kind of scratching their heads. Long-term interest rates are creeping up. Now that's usually a red flag that markets are getting worried about inflation down the road. And if that's true, maybe central banks need to tighten things up. But the question was, is that what was really going on?
Well, by looking at the whole situation systematically, they found the real culprit. The Berlin Wall had just come down, and rebuilding East Germany was going to require a ton of money, a massive demand for new investment. That's what was pushing interest rates up. It wasn't an inflation problem at all. It was an investment story. And because they figured that out, they knew they didn't need to overreact with their policy.
So, after seeing it in action, what's the big takeaway from all this? Why is this middle ground approach so powerful?
Well, it's because a systematic policy really does give you the best of both worlds. You get the credibility and stability of a rule. Markets and the public know there's a coherent plan. But you also keep the flexibility of discretion, which lets smart people use their judgment when something totally unexpected happens, the kind of thing no formula could ever see coming.
Taylor's work gives us an incredibly powerful framework, but it does leave us with a pretty critical question for our time. With shocks like a global pandemic or the super-fast rise of AI, what happens when the next crisis is so new, so complex, that even our most flexible frameworks can't quite keep up? It's a great reminder that the search for the perfect way to steer the ship, well, that's a journey that never really ends.